Hey, I want to thank everyone for showing up. My name is Colin Wines, and I apologize for running a little bit late here. We were running into some technical issues. And so you guys should have my video on, and I've got Phil McInnes from Avantis Investors on audio. And so he'll be joining us today from Austin, Texas. I'm down here in Lakeland, Florida, and I represent Larson Financial Group and all of the family of companies that we have at Larson. And so really what we're here to talk about for many of our investor clients, as well as folks who have stumbled across us from all sorts of different places, whether you're a client or not, we really kind of want to dig into the questions of, which is funny that we even have to ask the question, are we in a recession or not? And so Phil is going to be the expert du jour, and I'm going to really kind of be bouncing off him a lot of the questions that I hear as an advisor. We manage at Larson Financial Group about $2.25 billion. And so we've seen obviously a drop in the market. We've felt that, our clients have felt that, and there's tons of emotion and difficulty around that all across the board. And so we had a big 2021 and a crazy 2020, and now this 2022 has been a bit of a ride. So Phil, I've got some slides up on the screen that I'm going to be kind of going through, but you start us off. Just how would you answer the question if we are in a recession? And then from there, we're really going to get into what do we do about that, no matter how that gets answered.
Yeah, absolutely. And Colin, really appreciate you having me. And everybody, thank you for tuning in. I apologize, I'm audio only now, trying to get that fixed, although I'm not that good looking, so you guys aren't really missing anything. As it relates to kind of the content and what we're here to speak about, as you said, Colin, it has been a pretty bumpy ride, right? Even if we look at yesterday, a lot of red across the board. We saw some green today in stocks, which is always nice to see a little bit of a bounce back after a day like that. But when you think about sort of this year-to-date market environment with stocks in the U.S. being down around 16, 17%, right? That always feels a little bit painful. And I think, that big R word that we keep circling around of recession, are we in one already? Is there one pending? A lot of indicators that people look for, a lot of jokes around, folks at the White House changing the definition of what a recession is, because some people think about it as being those 2 quarters of negative GDP growth there, and people would say that we have had that. So I think there's just a whole lot of noise around issues like this, and as investors, right, it can be certainly a little bit. It can bring on a little bit of anxiety if you're watching the news a lot. If you're reading a lot of news stories on it, there's always going to be a lot of attention being paid to these kinds of issues, and maybe even some hyperbole. And so we try to just really get back to basics to try to think about what's going on with prices, right? So we're big believers in markets and the idea that as investors are coming together to trade, right, markets are clearing because buyers and sellers are coming together and agreeing to transact at prices. What are they deciding, right? What are they factoring in as they're deciding on what prices they're willing to pay or what prices they're willing to sell these securities for? And so I think what we'll hopefully be able to do as we walk through some of this content is dig in a little bit more about some of those mechanisms that are at play, some of the factors that go into the pricing of securities, and why we think over the long term, this is all stuff that should work itself out.
So Phil, I've got on my screen here this crazy graph showing that as of mid-June, the market, S&P 500 at least, US large cap market, was down 22.5%. And needless to say, this has been a bit of a crazy ride. And so how do you define whether we're in a recession or all of the things that are going on? I'm pulling up a slide here of issues that one could have been worrying about in 2022, just since the end of 2021, so just the last 9 months or so. So tell me a little bit more about this year and how we should be thinking about our portfolios or just the market as a whole and what it means for the macro environment.
Yeah, no, absolutely. So I think those issues that we have on the right side of that slide there, right, they're things that you've probably seen in the news, read about. We have seen the Fed funds rate obviously increasing. Right now they're looking at the next Fed meeting, what's going to happen. And obviously the Federal Reserve Board and what they're trying to do there, they're trying to get a handle on inflation. We saw the CPI print come out earlier this week, and it was pretty strong. Strong meaning pretty high. And so as they're trying to rein in inflation, there's even more anxiety around that, and what is that going to do to stock prices and risky assets and those things. So all of these sorts of issues, right, are things that people are factoring in as they're making assumptions about the future for the companies that they're investing in, right? And Colin, if you head to that next slide there, where we replace the basically that whole multitude of issues with a really simple sort of price model of, if we think about P, right, that price for an individual stock, what is that comprised of, right? It's clearly, when we're investing in equities as stockholders, what are we getting, right? Why are we investing in these companies? Well, we're investing because we'd like a share of their future earnings, their future profits, right? That's why we're investing in companies. They're an ongoing concern. The idea is that we can give them some of our capital now. They can use it to fund some sort of innovation, right? Some sort of service product, what have you. Obviously, generate some profits associated with that business, and then we as shareholders have a right to some of those profits. And so, really simply, if we think about the price of a stock today being a function of its expected future earnings, right, that are going out way into the future, and so a dollar in the future is not worth as much as it is today. So we're gonna, those earnings are not certain, right? There's some uncertainty associated with them for all the reasons we saw on the last page and more. Then they're getting discounted, right? And so that discount rate, which is a pretty fancy word, but that discount rate is really what our expected return or required return is as investors, right? So we take the earnings, project them out into the future, assign that discount rate to them, and that gives us this price today. So when you think about the prices and what we've seen in the decline in markets, right, that really choppy line that's over on the left there, as we've seen those coming down, then the idea around price is, well, if price is going down, then it either means that you think earnings must be going down, right? So these future earnings expectations have decreased, or that discount rate, that required rate of return is going up. And I say required rate of return because it's what sort of the market or investors are requiring to take on that risk, right? As they're thinking about projecting those cash flows out and discounting back. So what's going on in this instance? It's probably a mix of both, right? It's sort of both things that are factoring in. But this is something that's really common in markets, right? The choppiness is very common, especially in short term. And I think we need to think about sort of extending that window out a little bit and the lens that we view this through, because longer term periods, it's much less likely that you see negative returns for equities.
So repeating what I'm hearing you say is, we want cash of the businesses that we're buying in. Over the long term, we expect those to be something. And so that's why we're buying this in the first place. That's the simplest version. We are discounting that to today, but for all intents and purposes, we, just like if we were buying a Chick-fil-A or some other business down the road, we just are doing that because we're expecting it to spin off some sort of income, and that comes back to us in one way or another. Is that right?
Yes. Yep. That's fair.
So how does that look then on the macro level when it comes to the cycles that we go through? And I can pull up that cycle slide in terms of recession and expansion. And so how often are we expecting this, like whether we are in a recession or not? But talk a little bit about that and the cycles that we're through. And then I want to bring it to maybe what does it mean for like actual portfolios and decision making with our accounts?
Yeah, absolutely. So as you mentioned, sort of, if we think about sort of, business cycles and then markets, right? So the business cycles and business cycles are actually determined. There's even a fancy business cycle committee, right, at the National Bureau of Economic Research. And Colin, you and I were joking about this, right? The idea that when they are determining, right, a peak, right? So you see that economic peak over on the left, you see the economic trough. As they are determining those peaks and troughs, they aren't doing it in real time. right? They're actually they're looking at all sorts of data inputs. So they're looking at GDP, they're looking at employment, they're looking at spending, they're looking at a whole host of sort of economic indicators, right? Non-farm sort of payrolls. So that you hear fancy terms like that thrown around, and they're making a decision to say, is the economy still expanding, right? That's that expansion piece, or have we actually seen it start to recede, right? And that gets into recession. And so if we look at equities, right, because we have to connect what's going on in the economy with what's going on in markets and stock prices, because there's absolutely got to be some level of correlation or relationship, right? It's not always one for one, and it's not always in real time. So what we're looking at when we see those three numbers that are on that slide there, if we look at that average monthly return for stocks over the long term, right? And we're looking at a period of about 50 years when we're looking at these numbers. So since 1973, the average monthly return for stocks has been a little bit more than 1%, right? So what does that add up to? It's around a 12% annualized return. It's a good return, right? So that's what stocks have provided over this long term. If we start breaking that out in between these expansionary periods, right, that again are defined with some hindsight, but when the economy is expanding, you see that green number, it's actually a little bit better. And then those red ones, right, it's actually slightly negative. So slightly negative. Obviously, if we had perfect foresight, we'd love to sort of avoid equities during this recessionary period when we see the negative returns, and be in equities when we see this expansion, right? That would be the sort of the coup de grace. But if that's something where when you think about trying to time these things perfectly, that's also really difficult to do, right? While there's obviously a lot of economic indicators, those kinds of things, because prices are forward looking and prices react really quickly to new information. This slide that you see here is really, I'd say it's oversimplifying, right, what we're looking at. Because if you even compare sort of the expansionary months versus the recession months, the number of months that we've had in a recession is so much fewer, right, versus the expansions. We have it in a little bit of footnote there. The average expansion over this time period is 72 months, right, so about 6 years. The average sort of peak to trough, the period that we're talking about, is less than a year, right? It's around 10 or 11 months. So over this time period, we've been in an expansion a lot more than we've been in a recession. But still, anytime, the reason that why when we hear this word, recession, people are worried about equity returns is sort of this relationship that's seen. Now, from my perspective, this is something that is really, really difficult to time precisely, right? If we could do it, we'd love to avoid equities when we've seen these red numbers and be in equities when we see these greens. But I go back to that blue number, right? Because that blue number is being invested throughout, and you're still getting over 1%, per month on average. Again, a pretty good return, and that's holding across all months, right? So that's sort of my anchor point for over the long term. Stocks have done a good job of delivering, so it makes sense to maintain a good allocation to those over time, rather than making really big jumps in and out.
So we've kind of talked a little bit about the general movements of the market and what this has looked like year to date, and kind of how that might fit into the bigger picture. Let's talk about individual accounts. We had folks that are going to be joining today chime in with some questions, and for those of you who are on, there is a Q&A feature, so you can see on there somewhere in your app, you should be able to chime in a question. I'm watching that, and we will spend the last 5-10 minutes trying to get through some of those if you guys have any questions or clarifying remarks. And so, Phil, as I look at this slide, and from one of the questions that was submitted was effectively, okay, look, we know that there's recession, and we know there's expansion, and we know that we can't necessarily guess, but we can look at the past and we can say what's happened. Like, we know we are down from where we were 6 months ago or a year ago. And so one of the questions that came in was pretty simply, look, if the market dips, why shouldn't I just try to time the market? Why shouldn't I just dump a bunch of money in? How would you think about that?
I love that question. I think it's a very fair question. And when I put some of these dips into context, the thing that I think about, how you think about preparing for these sorts of things. So if we go back over the last 95 years here in the U.S., right, we have data for almost 100 years of stocks here in the U.S. We see that if we start to look at how often the market has declined 10% or 20%, right? If we look over the last 95 years, the market's declined at least 20% from its previous high 30 times, right? So about once every 3 years that's happened. So we have to be prepared for this to happen, right? If we take that definition and we say, it's about once every six. It's happened 16 times that it's gone over 20% down. I apologize. It's gone over 10% down 30 times. So every 3 years, about every 6 years, you've seen a 20% drop. About every 3 years, you've seen at least a 10% drop. So we have to be prepared for these to happen. And you might have slide 7 up there now, Colin. And this to me is a really good indicator of why, just because we've seen something happen very recently, it doesn't necessarily mean that it gives us a lot of information of what's going to happen in the near term, right? So we've got this sort of cloud-like pattern that you see. If I look at this vertical axis, the vertical axis is showing you the return over the next 100 days and the relationship to the return of the stock market over the last 100 days, which is on the horizontal axis. So if there was a really strong relationship between what just happened and what is happening very soon after, then you would expect to see a lot more of like a line, right? It could be clustered, but a lot more of a line sort of moving up and to the right or up and to the left. But instead, what you see is something that looks really a lot like a cloud, right? It looks like a swarm of bees, actually, or something like that. And so that cloud-like pattern tells you that there really isn't a strong relation between what just happened and what subsequently happens. So if you look, the next 100 days, right? If we have this full sample period, they've been positive 70% of the time. So that again, it leans to this idea of stocks tend to go up over time. 30% of the time they've been negative, with an average return over that period of about 4.5%. So this is getting into that idea of timing that bottom and the idea of, I've seen it go down, I want to pump a whole bunch of money in. Well, I'd say that's better than taking a whole bunch of money out, right? As an alternative, it still is something where you might not want to make just huge rash decisions either way.
So what I hear you saying is that there are times that I could have experienced on June 16th, for example, right? So this was what you said was the low in retrospect. It's been the lowest year to date. If you and I are talking on June 16th and we've got that slide that shows, oh my gosh, the market has just dropped a ton, I would say, oh my, this is the perfect time to put one in. And that would be really smart. If on the other hand, we were talking 2 days or yesterday and the market was down 4.5% almost. What I hear you saying is I've got a 7 out of 10 chance that it in the next 100 days will be positive. And on average, if I had 100 times to play this out, then it would come out to be a 4.5% rate of return if today was the all-time low. It would be a 4.5% chance that it would be it would be up on average 4.5% over the next 12 months. Is that right? Or next 100 days, next 100 days.
Over the next 100 days, and not necessarily just off the low. That's just any period, right? That's just picking really if we look at any 100-day period of returns and then looking at the next 100 days. So that's just a random draw of any day over the last 50 years, right? That's what slide 7 is really saying. Slide 8 is getting into that idea of
slide 8.
So slide 8 is getting into this idea of if we've seen a really significantly negative return over the last 100 days, which is kind of what we're in now, right? We're in a pretty similar spot there. That's absolutely what we were in as we looked at sort of the end of June. So we said, what if we cut this off and say, if over the last 100 days we've seen at least a 15% decline, right? So at least a 15% decline over the last 100 days in stock markets, what then happens? And keep this in mind relative to what we just showed you in terms of that full period. So you see that on average, more positive than negative, right? So 62% versus 38%. So those numbers have changed a little, but they're pretty similar. And then that average return has actually gone up a little bit, right? So it went from 4.45% to 4.75%. So again, this is sort of telling you that even if the market has gone down 15% over the last 100 days, it still doesn't give you a ton of information of what's going to happen over the next 100.
So when we get back to the question then, on average, it is a positive over the next 100 days. Does that mean that we should, every time it goes down, put money in? Like, is that we just sit on a bunch of cash, or how do you think about that?
So this is where, from my perspective, Colin, you're as much of an expert as I am, because this is all has to connect back to the goals that the client has, the financial plan that's been established, the asset allocation that's been established as part of that plan. Because in isolation, right, if my dad calls me, and this has happened in the past, right? He calls me and he said the market's off, I am concerned now, right? I'm afraid it's going to go down more. I want to take money out, and just as conversely, right? The market's down. I think it's a buying opportunity. I have some cash. I want to put it to work. Where should I put it? Right? Both of those scenarios have happened. And my answer to my dad is, well, listen, if you liked stocks 6 months ago at the prices they were at, and now they're at 20% off of those highs, then you feel like you're buying at a little bit of a discount and you want to hold them for the long term. Probably not a bad idea if you don't have another use for that cash, but it has to tie back to, what do you want to do with it? When are you planning on spending it, right? So that's where I think the role that you all play, call it at Larson, is so critical, because these decisions really can't be made in a vacuum. It has to be within that context of what's the overall plan and what are the goals that we're trying to achieve.
It's funny. 2 points on that. Number one, we have one of the questions, in fact, that came in was, could the 2022 recession, potential recession, we won't know until after the fact recession, look anything like 2008? And I want to hear what you think about that. But what's interesting is it's often called the lost decade from 2000 to 2010, because if you had been in the S&P 500, you effectively would have had the same dollar amount. If you had $1 million on January 1, 2000, then at the end of 2009, that 10-year time period, you'd have had about $1 million. And so that goes to the idea of a properly balanced portfolio, because if, on the other hand, instead of just being in the straight S&P 500, which is the context that we're talking about here, that a more balanced, diversified approach that would have been like any of our client portfolios that we typically see, of ours, which would have some international, some small, some large, some more diverse fixed income options, would have not done that. It would have been closer to about an 8 to 10% rate of return, depending on your level of risk, annualized over that period of time, because it's not just subject to the one whims of what the S&P 500's done. And so while we're looking at context of just S&P 500 here, that recession in 2008, which hurt so many to such a large degree, if was properly diversified, you would not have felt that to the same degree. Now, it still hurt. No one really enjoyed it. It still would have impacted a portfolio. I'm not saying that it those didn't drop, but certainly not to the same degree. The second piece is, when we're talking about, is now the right time to invest? Is now a good time to put money in? Many times, we have two strategies that get implemented that already solve that question for you. If somebody is on a basic plan, now again, those that are in retirement are going to be different than those in an accumulation period, and we have different strategies for each of those groups and different products and solutions that could make sense depending on which of those phases you're in. But for those that are in the accumulation period, who are still hoping to grow their portfolio, there's two things. One is regular rebalancing, which already does this, meaning let's just say you had a 60-40 portfolio, 60% stocks, 40% bonds. If you had a 22% loss as of June 16th, we would have already done some sort of rebalancing that says, look, in this case, bonds haven't fallen as much. That's something we'll talk maybe a little bit about later, but they haven't fallen as much as stocks. And so there'd be this natural rebalancing, which is we're underweighted, meaning we have too little stocks, and we would be selling potentially some of the bonds to buy some of the stocks to keep you at 60-40. Because what you might otherwise have gone to is something like a 50-50. And if, as part of your plan, 60-40 makes sense a year ago or 2 years ago, unless we've decided because of life, not the market, that we want to change our allocation, you will naturally, through some sort of rebalancing, will have that make sense again. And we have some tactical portfolios that are a little bit more forecasting and a little bit more forward looking, but most of our portfolios, almost all of them, will have some sort of regular rebalancing feature to that. The second thing that we see for accumulators is that if you are on some sort of dollar cost averaging, I'm doing my savings, whether you're saving to your 401k or you're doing something outside of that, then you are already buying on sale. Now, the inverse of that is you're already also buying as things are going up and potentially at a more expensive price. But the average of that is what allows you to get on a very balanced basis, or another term to mean cost to you. It's a very balanced amount, which means we don't have to time it today. You will absolutely get sometimes that it's high and sometimes that it's low, but we don't have to hit it on the exact right day. We don't have to guess June 16th that we never know is June 16th until after June 16th at the bottom, at least so far year to date. So those two strategies. So again, when we look at something like, hey, is 2022 going to be like 2008? My answer is it really wouldn't matter even if it was in 2008, if we have the strategies as a balanced portfolio, a balanced financial plan for you, and doing these not rigorous, but fundamental pieces to an investment portfolio, investment plan. So can you chime in a little bit about the 2008, 2002 looked like 2008, and chat a little bit about that?
Yeah, absolutely. And I think I loved all the points that you mentioned as well, Colin. I want to say that. So 2008, I think the biggest difference that I would highlight, right, when we think about the nickname that 2008 got, right, it was the GFC, the global financial crisis. And so that was really a banking crisis. And so we have different types of crises if we go back and look in time, right? And I would say, you certainly have economic slowdowns, right? You can have currency crises where you see really kind of hyperinflation, and that tends to happen. That's not something that we really have had to worry about here in the U.S. It is more prone in some really, really, really developing markets, right? But then the other piece that I would point to is this idea of a banking crisis, right? And 2008, when we say GFC, it was a banking crisis. And since we don't have those same things here, the banking crisis, if you look back in history, tend to be much, much worse than sort of just your general economic slowdowns. And when I think about this crisis, or if we want to call it that, right, of this impending recession, an economic slowdown, what have you, what is this really the subject of? If we go back to sort of the depths of the pandemic, right, and when we first had those COVID lockdowns, the world really came to a stop, right? So it came to almost a complete halt. And if you think about how many components go into making a computer or a car, or really just about anything we use these days, nothing is really that simple, right? There's a famous essay of Milton Friedman and a pencil, and how many different things go into making a pencil, and just sort of the beauty of markets and everything like that. If we think about all the things we consume in supply chain, the idea of everything stopping for as long as it did, getting it restarted takes a lot of time. And as every single business goes and is turning to as they're getting demand, right? There's a lot of pent up demand for something. They're turning back to their suppliers and they're saying, we need something, right? And everybody's trying to get started. And so if everybody's turning and saying we need something, then that's when you start to see prices go up. And this is more of sort of a global phenomenon in terms of inflation and what we're seeing. But when I think about sort of 2008 versus 2022, I see them as being very different, given that the 2022 was in no way a banking crisis. So I don't think, my belief is that we're not in something that is going to be really, really prolonged or as painful as what you saw in 2008.
So then let's compare and contrast with two other time periods. And the first is 2020 and the craziness that happened, you alluded to, with COVID and the impact to the markets. And I've got I'll pull up the slide here in a second to kind of go through some of the points you have on that with 2020. But then if you could also compare and contrast 2022, what we're experiencing today, versus 2020 versus one of the commenters has a question that says, look, if we look at something like another index, the Dow Jones, since 1995, sure, every time that there's been a downturn since the 70s or 60s, since the 70s, then you do have some sort of a growth period. But when you go further back, for example, to the 60s, there was a over 50% drop over a decade, which didn't recover until 1995. And so the question fundamentally is, like, are we in a period where it's just a blip, which we've been used to since 1995, or is, as the questioner asked, a much more insidious downturn that we're experiencing? So how would you compare what we have now versus 2020 versus even going further back into the markets where it took something like 30 years? And in this example, it was for the Dow Jones index. Or you could talk about the markets more broadly and how that might have impacted at that time, where you have a much more long-standing time before something returns.
Yeah, yes, there's a couple things there. So when I think about 2020, and we do have a sort of a case study around 2020 in some of the slides there that I don't think we have to review in detail, but we basically saw just such a severe, sharp decline, right? We think about the period from really kind of late February to the low was actually March 23rd, right? That was when the U.S. stocks kind of hit their lows. You saw, I mean, some of the fastest and severe negative returns that we've ever seen. And so that was this idea of all of a sudden the world stopped and people weren't sure when it was going to start up again. Now, what we saw was that prices started to recover pretty darn quickly, right? If we think about, you fast forward to, so we were in February 19th at that low, you fast forward to July of that year, and it had only been 173 days, and the S&P 500 had already recovered back to its previous level, right? That sort of pre-February 19th level. So that's a really, really short amount of time, and stocks obviously continued to advance, right? The S&P finished up considerably over that year, right? Almost 20% for the year. So when we think about, 2020 versus 2022, I think that the main difference so far is 2020, you had a lot of government intervention, both fiscal and monetary policy, right, where they were stepping in to provide liquidity, which it's a big role of central banks is to supply liquidity in times of crisis. So that's something that was happening on sort of the plus side in 2020. And then we had people adapt, right? There are new services that were coming, and people were starting to, again, sort of reset their expectations around what are companies going to be able to earn. I think that, one other thing that we saw in that time period that is in those slides there is a bunch of people really just got out of the market. There was more than $1 trillion that went into money market funds over that period that I was mentioning, of sort of that late February into sort of the early April, early to mid-April timeframe. And just about everybody, if you sort of dollar weight that and you say, based on when you got out, were you better off sort of, staying put, or did you save money by getting out? Even if we just look at that really short time frame, you're better off staying in for the majority of those dollars. And that doesn't even factor in that subsequent recovery that I was mentioning. That again gets back to this idea of discipline for me. In 2020 versus 2022, what do we have in 2022? We have inflation, right? And the Fed's trying to get a hold of that. Whatever prices you see they're baking in the Fed's expected actions going forward as well, right? So that's something that's already factored in. but we will still continue to get new information about prices and things and whether or not they're increasing, and that can put cost pressures on businesses and have a potential impact on profits and earnings. So I would say that there's just a different sort of uncertainty right now than what we had there. But there's always going to be uncertainty investing in markets, right? That's part of why they earn this idea of a risk premium. The risk-free rate, right, of sort of very short-term government debt, there's a reason that it's called the risk-free rate. Every other sort of asset has some sort of risk associated with it, and that's why we expect to earn a higher return over the long term, and over the long term, they have delivered a higher return. As it relates to Dow Jones in that period, like that index, that specific period, I need to go back and look at a little bit more closely. But the one thing that I would say about that index, and this goes back to your comment, Colin, around the last decade for U.S. large cap stocks. Well, the Dow is made up of 30 companies and it's price weighted, right? So that is it is something that gets quoted a lot in the financial media, right, as an indicator of the economy, everything else, and it has some companies in there that everybody would recognize. But if you start to look at and compare that even versus the S&P 500, right, or the Russell 3000, which is the top 3,000 stocks here in the U.S., that's a lot more indicative of the U.S. total stock market. And then you take a step further and you look at the global stock market, you've gone from 30 companies and a price-weighted index to something on the order of about 14,000 companies, right, across global markets. So I think that what happened with the Dow specifically, that still is a subset, right, a small subset of the market overall.
So when we look at that, then we're looking at a small piece that may not be indicative of what an investor's entire portfolio should look like. And while there may be times, and I know one of the other ones that's often quoted and it gives pause for concern is Japan. It was the one period of time for a 20-year time period where even if you rebalanced, even if you were trying to, as it continued to go down, you kept buying and buying, you would have lost money. And it was from something like, you might know the exact dates, like 84 to 99, 15-year period or something like that. And so there's anomalies. And in fact, what I believe is that proves the rule that because there are anomalies, that is not what I want to be investing in, is one thing, and put my money into that. And so I also think that whether it even be the S&P, there are times that this is probably a bit of a joke, but the S&P 500 is a visual representation of how rich people feel at any given moment. It sometimes isn't necessarily, as we're experiencing now, indicative of how the market was seeing, market, or how, generally speaking, the economy is doing, not markets. And so one particular index may not be indicative of what's happening in the full market. And so we might Vietnam, we had back in the 60s, 70s, and 80s, we had Iran crisis, we had all sorts of things that impacted fiscal policy, monetary policy, which obviously had significant impacts. But that's the reason that we be as broadly based as possible. Again, doesn't solve every single time for every single period over a particular time period. But what we do know is that diversification will be the better option than the alternative for the long haul.
Couldn't have said it better myself, Colin. Diversification is your buddy, right?
So tell me this, if we look at all of this, the other missing piece that you've mentioned one or two times, but is certainly felt by everybody, is the inflation. And while we all feel it as we go to the grocery store, where does that fit into the larger fiscal policy? You mentioned the Fed, you mentioned that they may be still increasing the rates. So tell me that if it comes in higher, it comes in lower, where at this point we're playing speculation, but how does that mean for investors' portfolios, where we're looking at whether it be fixed income or the things that we should be looking at for what we actually can control? And given that we got about 15 minutes left, in the next 5 minutes, we will pivot to what are the things that we can control and what are the actions that we can be taking. So if you want to use maybe inflation as a segue into that, that could be helpful.
Yeah, no, absolutely. And I think that does dovetail pretty well around sort of the, how much can you earn, right? How much are you spending? And if costs are increasing, what does that mean for the investment side of the equation and then the liability side of the equation, right? Both of those things matter in terms of your personal balance sheet. So if we think more about sort of on the asset side, I think inflation is something that we really haven't had to deal with for a good kind of 20-25 year period, right? And so maybe people have been lulled a little bit to sleep with it. You've had pretty low inflation, especially over the last shorter period before this last tick up. It was sort of abnormally low inflation, right? And so when it rears its head again, the idea that all of a sudden it's back with a vengeance. How do we get it under control? I do think that if we go back to my comments around the world stopping and then starting again, that is more of a global phenomenon, that it's not just something that we're facing in the US. And when you think about policy, you can look at some countries that I think would be viewed as having very sound fiscal discipline. So if you think about Norway as an example, their inflation levels are right about the same where ours are now. So I think if we think about sort of policy and then effects and everything else, that we do have to think about inflation as being more of a global phenomenon today. When we think about what does it mean for prices and the assets that you have and everything else, when I think about if we think that if we're worried about inflation and an adverse effect on our investments, we need to kind of go back and consider the alternative, right? If the alternative is cash has been a really poor hedge against inflation over time, right? If we go back to sort of the early 70s when the gold standard was abandoned, and we look at the purchasing power of a dollar, it's gone down, right? A dollar in 1970, in the early 70s, probably buys you somewhere around something around 15 cents a good today, right? So if you just left it in cash, stuck it under your mattress, you can't buy nearly as much with that same amount of money. However, even if you look at short-term conservative investments, right, like the 3-month treasury bills that we were talking about, commercial paper, which is another very short-term debt instrument. If you look at stocks for short, they've not only preserved that purchasing power, but many assets like stocks and everything else have increased it, right? So that again is, I think the worst thing to do is have sort of a knee-jerk reaction, say, I'm worried about inflation and its impact on stock prices, and then saying, I'm just going to turn to cash to solve that issue. And similar with bonds, right? I think if people are worried about inflation, the interest rates that are built into fixed income securities, right? Those have a component, a nominal and real component, right? So there's inflation expectations that are built into those interest rates. So while there may be unexpected inflation that arises, there is still an inflation component that is built in that investors sort of expect to earn in that fixed income. And so again, turning to cash, you aren't getting that. What I would probably turn to a little bit there, Colin, is more with you and your comment around what can you control. Well, on the asset side, if you don't want to make any really big knee-jerk reactions to your portfolio, then thinking about, probably more that spending plan, that saving plan, I think that's just as important in a scenario like this. And I'm sure you all have a lot of tools that you put into place there.
Yeah, so this is one of the odd times that when we think about what it is that we can control, and a couple of the questions that came in were related to taxes, right? And so we believe that while I can't control what happens in the White House and beyond voting, and I can't control what happens in Congress with taxes, we do believe that there are some actions that, at least within the current tax law, we can take advantage of. And so one of the things that is unique in this time period is many of you guys understand the benefits of tax loss harvesting, that as things are down, that we were able to take advantage of that and reduce to maybe even offset some of the inflation feelings that you have, whether you're at the pump or whether you're at the grocery store, a little bit less cash on hand. If we can, as a result of some tax loss harvesting in your investment accounts, reduce the tax bill that you hit. Now, that may not be a big deal for if you're in the accumulation page or accumulation stage, because it only offsets $3,000 of your ordinary income. But if you're someone who lives off of, as for some of our retiree clients, and you live off of capital gains, you would be feeling some of that as a result of previous sales of gains. And so if we can do some tax loss harvesting for some of your portfolio, that's usually something that happens with your stocks, right? And so when you sell something a little bit at a loss, buy something similar, you get that tax benefit and the write-off from your investments. This is one of the rare times where you're also able to do that with your bonds, given that your bonds are down. And so that's as a result of this inflation that we're experiencing and the increase in interest rates. As a result of that, the bonds are being hit harder, and you can see that in the secondary market prices. And so we're able to sell those when we perhaps may not have been able to in the past, and implement some of the tax loss harvesting. One of the other things on that, when it comes to taxes and what can we control with taxes, there are different types of investments that have implications on taxes. And so while our sister firm, Larson Capital Management, has some potentially some tax advantaged investments through their alternative investments, so we can talk about that, whether it be real estate or natural gas drilling that we've done in the past, and that can offset your ordinary income. And I'm glad to dive into that with another conversation or talk to your advisor about that if that's a concern for controlling the things that focusing on the things you can control, like some of the tax implications. Phil, if you can talk about the difference between what your company does at Vontis with ETFs versus mutual funds and the tax efficiency with that, and how that plays into overall client portfolio, because that is something that's germane to what's happening in today's environment, and focusing on the things that we can't control and getting just minute benefits, even if we can get an extra 0.2% or 0.5% additional benefit, then that means a big difference over the long term. So can you talk a little bit about that?
Yeah, absolutely. So on the sort of the investment vehicle side, right? So we've been talking a lot about kind of different asset classes and categories. And so you also have different vehicles, right? Means through which you can access capital markets. And so if we think about a mutual fund and an ETF, both of those are 1940 Act funds, as we like to call them. So they're commingled vehicles, right? You're investing capital alongside of other shareholders. You're getting access to typically a lot of companies in those, and if you've seen the rise of more systematic kind of strategies, you can get pretty broad diversification, right, at a reasonably low cost, and have reasonable tax efficiency. The ETF structure, that's something that's been around since the early 90s, is extremely powerful as a tax tool. And what I mean by that is, if you think about a mutual fund, then a lot of the activity, right, all the activity is really happening with cash. So if you're buying in, then our portfolio managers are getting cash and needing to go and spend that cash, like buying stocks. If you're selling out, or anybody else in the fund is selling out, then the portfolio managers see, they see that they have to go and raise cash to meet those redemptions. So there's buying and selling that goes along with any of that activity. Now, the rule, right, from the SEC is that if we realize any gains inside of that mutual fund or ETF, right, regardless of the vehicle, if we realize gains in there, we need to pass those through to shareholders, right? So that ends up being a tax bill. In the mutual fund case, right, again, we're having to deal in cash. In the ETF, there's what's known as an in-kind create and redemption mechanism. And all that really means is there's a middleman, right, an authorized participant, they're often called, they're market maker, where our portfolio managers are not really having to transact in cash. If you're buying in, there are shares that are created into the ETF, and that market maker is delivering a basket of securities to our portfolio managers. Likewise, if you want to redeem, if you want to sell your shares, then we're delivering a basket of securities to that authorized participant and not having to sell securities. So that means that in-kind activity means that we don't have to sell securities and realize gains inside the fund. And so that means we don't have gains to pass on. So if you look, and there's folks like Morningstar who have done studies on this and compared ETFs relative to mutual funds, we're big fans of that ETF vehicle because you don't have to have a capital gains distribution, right? We've actually done studies of looking over really long time horizons. If we're talking about like a 20, 25-year period for the same investment with the same assumed rate of return and that same breakdown in terms of like how much is associated with income versus capital appreciation, and you see really significant benefits to the ETF structure because of that deferral, right? You're leaving more money inside the fund because there aren't those capital gains distributions to allow that to appreciate through time.
So my general rule of thumb that I always use is more money in your pocket often comes out of either fees or taxes, or obviously if we could just boost returns, then everyone would love that. But the things that you can typically control are fees and taxes. And so we at least start with those. Other things, and I know we're kind of coming up on the line here, and so feel free to chime in if there's any other questions. I'm going to kind of go through some other things that we are seeing folks do as part of their portfolio these days. And so I'm going to walk through some of those. Number one is a lot of folks are looking also into more alternatives who have not done that in the past. And so that could be things that have tax advantages, as I mentioned earlier, real estate, which provides some depreciation, offsetting some income these days. It could also look like, as I mentioned before, some natural gas or drilling operations that can provide some tax benefits. So alternative investments, and it's something that we help many of our clients with, providing, vetting, and looking at those in a manner for how it fits into your overall portfolio. The second thing is as markets are down, it's typically a good time to be looking at Roth conversions. And so the general idea there is if you had $100,000 that it was worth as of earlier this year, and it may be worth only $85,000 now, I would rather pay taxes on $85,000 than the $100,000, even at a future tax or at current tax rates. This is a great idea for those that are in retirement and are wanting to give assets to their children or grandchildren and future beneficiaries. Pay taxes today, let that money grow tax-free, pay it on a lower amount, and then again, 85,000. And then let's say that the market does boost back up, as our questioner was asking. Maybe this is just a blip, it comes back up, as we saw in 2020. I would have much rather pay taxes on the 85,000 than at a much higher amount, or when your beneficiaries will receive it, hopefully at a $250,000 or $350,000 amount. I would rather have them not pay taxes at that. So Roth conversions are another big thing. We have some folks who are asking us questions about I bonds, and my general rule of thumb on that is, look, if the alternative is sitting in cash, because these max out at only $10,000, probably a fine alternative to a CD or sitting in a bank account, because these are now paying 7-8% with inflation, these inflation adjusted bonds, but it generally doesn't fit into a client's portfolio as a giant piece, because when you look at $10,000 divided by an average portfolio, it's a relatively small percentage, and so it doesn't move the needle a ton. But we do have some clients who are looking into that, and that's done on an individual basis. Other things are if you are in the accumulation phase and you are not doing some sort of regular savings accumulation, I messed that up altogether. Yeah, you got it. Then the regular dollar cost averaging is very important. So that just gets you into regular cadence of saving. That then ensures that you're getting a good pricing on that. So get into regular savings plans where you're otherwise, if you're the type that just sits in cash, that's an exceptionally difficult time to do, to try to get it exactly at the bottom. Regular dollar cost averaging gets you into doing that. Other things that we have are, we do have clients who are looking to more tactical portfolios. If this is a fit for you and you think that you're willing, the way that your capital market assumptions line up with somebody else's who is really scared, you may say, well, man, what's happening in Germany? There are tilts towards a little bit more aggressive sleeves in your overall portfolio. That doesn't necessarily mean you have to move straight to cash. and then get in and get out. But there are some tactical allocations, and this is only for a very a unique subset of investors who believe in these capital market assumptions and this way of looking at the world. But there are some tactical portfolios that can be deployed as a result of partnering with some really good firms, bringing them into the Larson family. We've gotten some alternative models there. And so overall, between that and then other tax advantages, we talked about some tax loss harvesting. There are options for insurance-based products, depending if you're in retirement and you want to lock in or buy some insurance on your investment to make sure that it doesn't go down, but you can participate in upside gains. With floors and ceilings, there are a multitude of different things that people can do, and not one of these is going to make sense for everybody, and all of them don't make sense for any one person. And so that's why we really encourage you to talk to your advisor if you have one. If you do not, we would love to be able to talk to you more, help you walk through these questions that you guys have, whether it be as a result of inflation or recession or your individual portfolio, or how can you diversify into alternatives and take some of your money into that? How can you be thinking about giving money to future grandchildren and paying taxes on it today at a lower balance? A lower principal. These are the types of things that a full plan will help answer. And so that way, it's not just a one and done, it's a regular ongoing basis and a regular conversation to ensure that your portfolio is reactive and proactive to what's going to be coming into the future and what we know has happened. So Phil, I really appreciate the time that you've taken to walk us through what we should be looking at as a result of this crisis in the market, and ultimately what we have all been feeling, whether it be at the pump and the gas station in our portfolios, and really appreciate you kind of educating us all on that. If you are not a Larson client and you are looking to connect with us, please either reach out to us on larsonfinancial.com. If you are a Larson client and you want to check in, please reach out to us at your advisor. Thank you again, everybody, for coming on out. Phil, it was always good talking to you, and I hope you guys all have a wonderful evening.
Thanks, Colin. Thanks, everybody.
Yep, take care, guys.